So how does a cash flow forecast work? Well, and we're going to give you this on a CD, by the way, the tool itself. So can everybody use Excel, yeah? Yep, excellent. So this is an Excel tool we've developed. All you've got to do is put the numbers in. You put your opening bank balance. You're happy about this, or you're going to design your own? Or, huh? You're smiling. That's a good thing. Oh, you don't like Excel? Oh. You will when it makes you money. Forget that it's Excel, because it's just a spreadsheet. So essentially, this is a cash flow forecast. It records a few things. Cash in, so it tells you how much cash is coming in. And sometimes you have to guess, right? You have to guess as to what's coming in, because you don't know exactly what you're going to get. But what I typically tell people is, you know what? Look at the last 13 weeks, which is a 3-month period or 90 days. Total the sales that you had come in, or the cash that came in. Take 10% off, divide it by 13, and that's your weekly cash in estimate. At the end of the week, update it with the real number. Same with the cash out. If it's not something that's predictable, just make something up. Add 10% for a bit of safety. You'll never kick yourself for it. You'll always be happy you did it, because you'll always have more than you thought you were going to have. So cash in is one thing that we're going to record. Cash out is the other thing. And then all that it records is what's left. That's it. And every week, your bookkeeper should be matching it up and balancing it with your accounts. Very simple to do if it's done weekly. And it'll create a system and good cash habits in your business, because what will happen is when an invoice comes in, you take that invoice, you look at the due date, you enter it in on your cash flow forecast as cash out. If you already had a guesstimate in there, you delete it and you replace it with the real number. And then you put that invoice into a folder that says to be paid. You don't have to look at that invoice now again until you get to that week and it says that person needs to be paid. And then you go to your folder and you pull that bill out and you pay it. And when you pay it, you just make it a different colour on the sheet to say I've paid it. Very simple system. Now, if you don't have the money, then you can just start copying and moving, cutting it and moving it. At least you can go, okay, well, I know that in that week, because what happens is down the bottom here, you end up with brackets around numbers that are negative, which doesn't mean you don't have enough money. It's just mean you're paying things at the wrong time. Okay, so as you go through the cash flow forecasting tool, you'll see it's very, very simple. The instructions are all in there. Make sure you start using it immediately. It'll give you 90 days of cash flow forecasting and you'll know straight away. Now, the good thing about this is if you are going to be short of cash and you know you don't have enough no matter what you massage, guess what you need to do? Get more sales or get a loan, cut back on your, get rid of the Lamborghini. You're going to have to make some changes, right? All right. Next thing is your profit and loss. A lot of people are bamboozled by the P&L. In fact, it's a real shame that most business people only look at their profit and loss on an annual basis. You should be looking at it on a monthly basis. How often? And you should look at it by the 10th day of the following month. By the 10th day. And there's no excuses these days because everyone's accounting is automated. It's all online. It's so simple. And if you don't have an online accounting package, get one. Is that simple? Get one. You pay by the month. I don't think they're very much. Does anyone know how much they are? $24 a month. And they link with your bank account. And every time you make a transaction, it goes into your books automatically. And the first time it goes in, you've just got to code it and tell it what it's for. Your bookkeeper does. The next time you make that exact same transaction, your books just automatically put it in the right category. Leverage, systems, technology. Easy, isn't it? You know, I see so many people that aren't leveraging off of this stuff. So what's in the profit and loss statement? Pretty simple. Here's an example one up here for you. So you can see the top there is your sales and your income. That just tracks what's coming in. Now, once again, when you set your P&L up, you've got to set it up so it works for you. Not for the accountant, not for the bookkeeper. It's got to make sense to you. So if you want to track 20 different sales categories, track 20 different sales categories. There's nothing wrong with that. You work out because you need to be able to look at this report and know what on earth is going on in your business. What are the products and services that I'm selling that are making me the most money? Guess why you want to know that? So you can do more of it because you're in business to make more and have more time, which takes more money. Pretty simple, isn't it? So you just got to control what's going on. So that's your income. You want to know what they are. The next thing is what's called your cost of sales, the second part of a profit and loss statement. Same thing. Split up all the categories so it makes sense to you. Now, cost of sales, for example, or cost of goods sold, is the cost you incur when you get a sale. sometimes also known as a variable expense. I'm going to give you a small accounting lesson, but that's about as good as it's going to get. Just so you understand now, the reason why it's important to understand what a cost of sale is versus a fixed expense, or a variable versus a fixed, is if you put your variables into the fixed or vice versa, it will affect your break-even number, which we're going to talk about very shortly. So you've got to make sure you get it right. So a cost of sale is a cost that's incurred only when you get a sale. So let me give you an example. You sell carpet. When you sell that carpet, it becomes a cost of sale, because to sell the carpet, you've got to do what? You've got to buy it. Make sense? So you sell this carpet, the carpet becomes a cost of sale, or cost of goods sold. There'll be a G in there because it's goods. And now you've got some contractors that you ring up. They come and pick the carpet up from your factory, take it to the customer, and they install it. Are they a cost of sale or a fixed expense, those contractors? They're a cost of sale, because you're only going to incur that cost when you get them to install the carpet. Does that make sense? Now, if they were employees, would they be fixed expenses? Yeah, of course they would be, because you're paying them regardless of whether or not they install carpet. Now, does this make sense? So it's very important that as you go through your business, you identify what are the things that I only incur when I get a sale, and those that I have to pay regardless. Now, the word variable gets people confused in accounting. They think if it's an amount that changes, it's a variable. Variable is the same as cost of sale. Variable means it's a cost that's only incurred at certain times, like i.e. when you get a sale. It's just another word that they use to explain cost of sales. Your telephone bill, whilst it changes in number, is still a fixed expense. Why? Because you've got to pay it whether you get a sale or... Does that make sense? Unless, of course, you were like a marketing company that only paid for calls when you charged the customer for it. Then they'd be a cost of sales for those particular calls. Does that make sense? Okay, so really important to understand that. And once again, you want to break it up so when you look at the report, it makes sense to you. You can say, there's my income from that particular thing that I sold. Here's the costs associated with that, because now I can work out what my margin is, my gross profit margin. And I want to sell more of the stuff that makes me a higher margin, which means I can incentivise my team to sell that stuff. I can do my marketing campaigns directed towards selling that stuff. In fact, there might be some things in your business that you don't want to sell anymore because you work out they're not profitable. Now, for some businesses, there are things that are not profitable. That's what gets people in to buy the profitable stuff. Anybody here got a service station? Anyone know anybody that's had a service? Anyone been to a service station? Good, okay. How much profit do you reckon they make per litre on the fuel? How much? 4 cents. 4 cents is a good day. 4 cents is a good day. Sometimes sometimes they break even. However, is it the most expensive Mars bar you've ever bought? Yeah. Is the milk got good margin on it? Yeah, absolutely. You know, everything else in that place is expensive because, and you know, you got to pay for your fuel, you got to lean over it like this. Oh, Mars bars. But you've also you go in now, it's rare you go into a service station that's saying, oh, by the way, if you spend $5, you'll get a cent a litre off fuel. You've seen that now? Oh, you want to buy 2 of those bars for $5. Because it's still huge. It sounds like you're getting a deal, but it's still expensive. Still more expensive than if you went to the supermarket. But we're willing to pay the price. Why? Because it's convenience, right? So they've learnt this. They've learnt that it's what's called a loss leader. They know. So really, if you thought about if all they did was sell fuel, I mean, even let's call it 4 cents a litre, how many litres do you put in your car each time you go in there?
450 litres.
Let's say you put 100 litres in and they're making 4 cents a litre. Oh, that's a big tank, right? 100 litres. How much are they making off that? $4. Would that be worth it? No. But this is why, do you notice how you can't pay at the pump? What's the only way you can pay at the pump? What credit card? The only people right now that allow you to pay at the pump is Woolworths. And you must have an everyday credit card. Because what happens when you pay at the pump? They're making money out of you with your credit card. Make sense? But they don't have pay, because you think, why wouldn't they have pay at pump? Doesn't that make complete sense? I actually think there's an opportunity for someone to open up a service station that is completely automated, where you don't have to buy Mars bars, and they charge you a bit more, but you can just pay at the pump. It'll be faster, straight through. BP card. So unless you've got their card or their credit card, you can't pay at the pump. They know this. They know that where their money comes from is when you buy bread dog food, whatever it might be. I mean, they sell all sorts of odd sods there, don't they? I mean, I'm sometimes amazed what they sell at a service station, but they do. Next thing is then fixed expenses. So these are all the costs you've got to pay no matter what. So you don't even open the door, they're just stuff that's got to be paid for. And then the final thing is then your profit or your loss. That's it. So there's 4 components to a P&L and that's it. It's that simple. It's not complicated. Sometimes it looks complicated. Sometimes they're great big reports with numbers all over them, but essentially that's all they're recording is your income, the cost of getting that income, your fixed expenses, and then your profit and loss. There's a 5th thing that goes in between your cost of sales and your fixed expenses, and that's just your gross profit. So you can see it's sort of separated there. So you can sort of see what your gross profit is, and that's how we work out your break-even point. Now, the good thing about understanding how a P&L works, now we can put a budget together. Now, once again, on this CD I'm going to give you is another Excel spreadsheet. Sorry about that. But it's a brilliant spreadsheet because it's an emulation of a profit and loss statement, which is all a budget is. And it's got 12 months in it, so you do it for the financial year. You put all your figures in of what you'd like to do for the 12 months, how much profit you would like to make, and it does a summary for you. And at the end of every month, you just print off your actual P&L, and get your bookkeeper to enter in the actual numbers, and it will tell you where you went under or over. Is that a powerful thing to know? Hello? Yeah. So if you spent more than you budgeted for, it's going to tell you. If you saved money in an area, it's going to tell you. And just by looking at that every single month, you will start to get an understanding of where your profit comes from, and you will make more money. It is pretty much your business blueprint. And a lot of people get confused about what a budget is, but a budget is really your goal, profit and loss statement. It's what you'd like to see happen. And once you set that plan, or that blueprint of what you'd like to see happen, now you can actually put the numbers in to make it work. And if your numbers don't work, you can then massage them for the entire year until they do work. Powerful? Hello?